Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Good morning. Welcome to the show. Of course, it's Two Dads on Money today. So John Penn and I will be talking a little bit about things that'll trip you up on debt. In other words, debt sabotage. I had this stuff happen to me when I was younger in my life, and it's kind of a mess to work through, but we're going to go through some of those things today and some of the things that you need to do to, and this really doesn't matter what age you are, whether you're young, middle, older age, ancient like me. This happens to everybody, and particularly when you get, elders in particular. There's a lot of debt sabotage that happens to elders by children. So we'll talk a little bit about that this morning. Things to watch out for, things to try to hedge some of that risk. Outside of that, tomorrow, of course, is Fed announcement today. 85% of kind of the surveys all expect the Fed to cut rates by 25 basis points tomorrow. The real question is really not going to be the rate cut. It's going to be the language that moves the market one direction or the other. If it's more hawkish, suggesting that, well, maybe we don't see further rate cuts, potentially a pause in rate cuts, that type of thing, market's probably going to sell off tomorrow. But again, if the language comes in fairly dovish, still talking about, particularly liquidity concerns that they've got to be paying attention to, that could bode well for markets tomorrow. So again, markets are going to kind of just trade here sideways for the next day or so, really until tomorrow afternoon, and we get that announcement, and then that'll kind of set the market in a direction at least for a few days before we get into the year end. But we'll talk about that a little bit more in a second. Economically, some of the data is continuing to come in fairly weak. We saw consumer confidence continuing to decline. It's really weak here, and expectations, example, for income growth next year are falling. Expectations for better financial positioning next year. In other words, will your finances be better next year than this year? That's been declining fairly sharply. So the outlook in some of these, kind of economic indicators suggests some weakness here. And again, that kind of bodes along with some of the other data that we're seeing. So despite the fact that we're seeing, the markets do well, we're seeing a lot of kind of robust expectations for next year and earnings growth as an example, the economic data still suggests a bit of weakness here. So at least some caution as we start to move into 2026. Here's a good example of this. Just posted a chart this morning on X. So if you go by @Lance Roberts on X, we're almost at 100,000 subscribers. So if you could go subscribe to X, just get me there. That's kind of my goal. So just get me to 100,000. I appreciate it. But @Lance Roberts on X, I just posted a chart this morning talking about the percentage of stocks in the Russell 2000 that have no earnings. That's 40% of the index has no earnings whatsoever. Now, why is that important? Well, it's important because you're paying for an index based on expected earnings growth, but only 60% of the companies are actually carrying the earnings. And more importantly, next year, analysts expect that the Russell 2000 will grow earnings by 60%. That's 59%, rounded up to 60 next year. But that's going to have to be carried by 60% of the index because 40% of the index has no earnings. So, that's the real kind of risk as we start to move in next year, is that expectations overall are very, very high, but yet some of the underlying economic and fundamental data just doesn't support that things are going to be as robust as currently expected next year. So again, it's just something, I've got a lot of articles going to be coming out over the next 2 weeks talking about 2026 outlooks. We started one yesterday, so if you haven't been by the website yet, realinvestmentadvice.com, yesterday's article is kind of setting up yesterday's newsletter, this weekend's newsletter is setting up for kind of this 2026 outlook. We did kind of the bull bear case for 2026. And over the next couple of weeks, I've got a couple more articles coming out talking about valuation ranges, expected rates of return, all those type of things for 2026 as we kind of start, kind of setting up portfolio management for next year. Anyway, that's all on the website and coming on the website. We'll be talking about those articles, here on the show as they get published. But again, it's at the website, realinvestmentadvice.com. Make sure you're subscribed, and we email these to you as we produce them. We'll email them directly to you. Just go to the Market Research tab right there on the homepage. Scroll down just a little bit. It says Market Research, And underneath that, you can subscribe to our daily market commentary, daily blogs, newsletter, and our YouTube channel. So if you're not subscribed to our YouTube channel right now, click while you're here watching, click that, subscribe, like it while you're here too. That certainly helps us out. All right, here's what you need to know before the bell this morning. We talked about yesterday that don't be surprised if you see a little bit of weakness in the markets here over the course of this week. We're still in the middle of mutual fund distributions right now. That's going on. And so you're going to see a little bit of choppiness potentially in the markets. Plus, we had a really decent rally coming off this kind of Thanksgiving low that we had going into Thanksgiving. We had this 5% decline-ish going, in from October, first 2 weeks of November. Everybody was very concerned about the markets. Since then, we've recovered all of that, and we're starting to challenge, back here at all-time highs. This has just been a really big, kind of consolidation range now for the last, kind of month and a half. Just really not going anywhere, just really, as we talked about yesterday, just consolidating that big rally that we had from April till now. So again, not surprising the markets are struggling to kind of advance here. They're still very elevated above the 200-day moving average. We're getting a little bit overbought. We are on a momentum buy signal, so that is supportive. And as we talked about yesterday, just kind of expect a little bit of sloppy trading here. Even a bit of a pullback would not be surprising to come down, potentially retest the 20-day moving average, which is also where the 50 is, right around 67.30-ish, 67.40. Bounce off that, trade higher into the end of the year. That would kind of really set up with seasonal patterns as well. So again, between today and tomorrow, again, what could cause that? Fed's a little bit more hawkish tomorrow than expected. Markets sell off a bit, and then markets start to reprice, start to look forward into next year. They start anticipating further rate cuts. They were hawkish now, but next year it'll be better. That's always kind of the outlook for Wall Street. And then, of course, you start to build in, window dressing for the end of the year. So, and again, you kind of wind up maybe back where we started. But again, this is just kind of where the market is right now. This is going to turn out most likely, unless something just goes horribly wrong between now and the end of the year, we're likely going to crank out 16, 17% returns for this year. That'll be the third year in a row of near 20% gain. So again, it's going to be a very good year, but that also kind of sets us up for questions about 2026. Anyway, just kind of keep paying attention to this. Nothing wrong with the markets right now. They're a little bit extended. A little bit of sloppy trading here would not be surprising. But again, positioning your portfolio for year end, I wouldn't make any major changes expecting a big decline between now and the end of the year. Could it happen? Sure, anything can happen. But most likely, markets are going to kind of travel sideways here, maybe a little bit higher as we get closer to year end. That's what you need to know before the bell this morning. When we come back, pick up with John Penn, and we'll get into debt sabotage. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economics Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, good morning and welcome to the show. John, good morning. How are you?
Good morning.
Awesome. So a couple of things to talk about this morning. One is, a little bit about credit, debt, those type of things, because, again, we talk a lot about using credit, right? Talk about, not to get into a lot of credit card debt. We talk about that a lot. But what we don't talk about a lot is protecting your credit. And there's a lot of things that can happen to individuals. I've had this happen to me. As a good example, I've seen it happen to other people where things occur and all of a sudden one day you decide to go out and I'm going to go buy a new car, or I'm going to go get a mortgage. I'll give you a good example. Happened to me. I was getting ready to buy a house with my wife. This was a few years back. And I look, and it's important too, because you look at your, if you go to like Credit Karma or something like that, you look at your credit score and you're like, oh, my credit score is great. There's multiple versions of credit scores. There's not just one credit score. And yeah, there's 3 different rating agencies, they're Experian, TransUnion, et cetera. But there's different credit scores, and they all comprise different things. And so I was looking at my online credit score. I'm like 750. I'm like, I'm good. I'm going to go apply for this mortgage for the house, no problem. So I went to the bank, applied for the mortgage. They turned me down, and they go, your credit score is not high enough. You've got a 680 credit score. I'm like, no, I don't. It's right here, 750. Like, no, it's 680. And so we went and did what I should have done a long time ago. This is like a decade and a half ago, so this is old. But I went and pulled my actual credit report, and there were charges, there were collections on my credit report for things that did not belong to me. And it was just somebody that had my same name, entirely different state, but it got put on my credit report. And so I had to go through the process of chasing them all down and getting them removed off my credit report, and it was fine. But this is why it's important to always check your credit report. You get a free credit report every single year. So you should pull your credit report at least once a year, if not at least every couple of years, and just keep an eye on it, because things can happen, right? There's just things that happen. And one of the things that also happens is that people actually, they get a hold of your information and they charge up things in your name and you're not aware of it. And then all of a sudden you go to pull your credit report and all of a sudden there's a bunch of charges on there that don't belong to you. So this happens. And it's not just nefarious actors. I've seen this happen a lot with elders as they get older. Kids start taking care of them, whatever it is. They get into the finances. They start using the parents' credit to start running up other debts, and it's a sad situation that happens. But this just recently happened to a friend of mine. She was getting much older, and her kids ran up. She didn't know this, but her kids ran up like $200,000 worth of debt in her name.
Wow, yeah.
And so again, those are just things you need to be aware of. This happens. It's frequent. It happens often, and it's something that just need to be paying close attention, because it may not bother you until you try to go buy a house or buy a car or something else, and all of a sudden this stuff pops up, and it can take quite a long time to get it straightened out.
It can. I mean, with the number of folks that we visit with on a regular basis, just the topic of protecting accounts and trying to get yourself out of being subject to that risk is a very common conversation that we have. I mean, you just look at the Federal Trade Commission. So you look at just the number of acts of fraud. For 2024, it was over 1.1 million identity theft reports just in 2024 alone. We're not through 2025 yet, we're close. It was roughly $12.7 billion of fraud. That's not a small number, right? And so Lance, you were talking about checking your credit report every year. So you can go to annualcreditreport.com, and annualcreditreport.com, you can pull your credit reports from all 3 bureaus, Equifax, Experian, TransUnion. You can get a free credit report every year. You don't necessarily need to pull all 3 credit reports at once. What you can do is you can kind of stage these out. Maybe pull Equifax first for say January, February, March, April for the first 4 months of the year. Pull Experian for the next 4 months, and then you pull your TransUnion report for the final 4 months of the year. So you can monitor your credit for the full year, and it's complimentary, right? So every year you really need to check your credit report, because you can see, are there accounts on there that you haven't opened? Or do you have revolving lines of credit out there that you have not opened? And it's just a very great practice to get into, no matter what your age. So, hey, moms, dads, parents, if you're listening out there, talk to your children about this. Hey, younger investors out there, go to annualcreditreport.com every year. Pull your reports from Equifax, Experian, TransUnion. It's quick, it's easy, it doesn't cost you anything. and it's just a very easy practice. It's worthwhile.
Yeah.
Right.
And again, and also too, it's just important to have kind of good, healthy habits about just maintaining your credit. Look, your credit score is, unfortunately, right, this is just the way we are in society, everything you do revolves around your credit score, right? You want to go buy a car, you want to buy a house, you want to apply for a line of credit. It's all around your credit score. So protecting the health of that credit score is very important as well. So again, it's not just monitoring what other people might be doing to your credit score. It's also worth pulling these reports to make sure that you're maintaining, the best quality health of your own credit score. So in other words, you don't, the more credit lines you have open, it actually starts to impair your credit score. If you have a lot of every time somebody pulls a hard credit check on you, so, look, it's Christmas time. Every time you go to a store right now, they go, hey, if you'll open up our credit card, you'll get an extra 10% on this, right? So you go, yeah, sure, give it. I'll just take the credit card and I'll pay it off at the end of the month, and then that'll be great, right? So I get an extra 10%. Well, that hard pull on your credit impairs your credit score. And so if you do that multiple times over the Christmas holiday, great, you got 3-4 credit cards, it's great, you're gonna pay them all off at the beginning of the year, right? You're just gonna, as soon as you get the bill, you're gonna pay them all off. Then also make sure you close the accounts at the same time, because having a lot of multiple credit lines open on your account will also impair your credit score. There's a big myth that you have to have credit card, like you have to have debt to have a credit score, and that's not true. You just need to pay your bills on time, and you'll have a good credit score. It's a novel concept. Pay your bills on time. But again, there's things that you can do that, again, everybody's going to offer you credit, and the better your credit score is, the more offers you're going to get, that can also impair your credit score as well. So again, if you're trying to achieve, and look, I have been working for years to have the perfect credit score. It's just like a personal habit right now. It's a challenge. Like I'm just trying to get to that 850 credit score. Never have gotten there, right? There's always something. But again, it's one of those things that, it's important to have, it's important to take care of, and it's important to monitor, because it's very easy for things to happen that'll catch you off guard.
Yeah, so if you're looking to protect your credit, you can always put a freeze on your credit, or it's a credit freeze, which means that if you put a freeze on your credit, nobody can open new credit in your name, including yourself, right? So so credit cards, loans, any sort of financing, put a freeze on your credit. That way, nobody can try to use your information to take out a line or open a credit card. If you freeze your credit score is not affected. And now, if you do have existing credit cards or existing loans, those will not be affected. Those will still work, but that also means that people can attempt to hack into those, right? So this is, if you freeze your credit, it is to prevent applications for new credit. It doesn't necessarily protect your existing credit lines. Freeze your credit, it's free, and then if you freeze your credit, you can control when to unfreeze, or what they call thaw your credit, or refreeze it, right? So if you freeze your credit, and then let's say you're out there looking for a home and you want to apply for a mortgage, you need to unfreeze your credit to apply for the mortgage, right? So a credit freeze is also, it's free, and it's just another way to provide an extra layer of protection if you're concerned that folks might be, if you're just wanting to protect yourself and protect your identity, and just prevent others from taking out additional lines of credit in your name.
That's right. So again, it's just good, just good maintenance of your credit score. Again, this is something that applies to people of all ages, but particularly younger, as you're just getting started out. It's really important, because everything you do when you're younger, and this is one thing with, like, I work on with my kids right now, is they're just getting started in life, and of course they're I've got 2 in college right now, and they're getting just every week they're getting a credit card application. I'm like, throw it in the trash. You just, don't get into that trap, because once you're in that trap, it's very hard to get out of, and it really makes the rest of your life very difficult. If you start out life heavy in debt, it's very difficult to kind of get ahead of that. You're kind of constantly swimming below the water. So, we all want things, and we have this need for immediate gratification. So we'll go out and we'll, buy phones or buy cars, whatever. Yeah, put it on debt. I'm good. I'll just make the payments. It'll be fine. But once you start to rack up a lot of this debt, you're just starting to divert more of your income to non-productive uses. And this just, we talk a lot about government debt. We spend a lot of government debt on non-productive returns. We need to be thinking about our own budgets that way, which is making sure that we're not spending a lot of our income, our disposable income, on non-productive assets, which is debt. So again, trying to manage that and trying to be prudent about where you're spending money, how you're spending money, those are very important. And of course, monitor. Those will also help build your credit over time by, again, paying your bills, doing these type of things, being on time, don't be late. Those are the important things, but then also making sure you're investing that money. We'll talk about budgeting here in a second, but investing that money, that your income, so that it grows so you can use less debt in the future.
Right, and there's good debt. In my mind, there's good debt and there's bad debt. And what we're talking about here is very high interest credit card debt, right? Where, and to your point, what I like to say is what goes, the payments that you make towards high interest credit card debt, the payment that you make towards those loans doesn't go anywhere else, right? It doesn't go to support your financial future. It doesn't go into your retirement plan. It doesn't go into your Roth IRA if you're a younger investor. It doesn't go into your overall savings to build your wealth over time. It's just a cycle. It's like a never-ending cycle to pay off high interest credit card debt. You just look at the amount of time it would take to pay off a credit card if you're just paying the minimum balance or the minimum payment every month. I mean, depending on the balance on the credit card, it might take 10, 20, 30, 40 years to pay off that card, right? And credit card companies, they know this, right? I mean, they know this. So that's like our daughters too. Our daughters are 23 and 25. Our youngest daughter's about to graduate from college this month. Can I get a hallelujah? So, but she is getting, and she lives at home with us right now because where she goes to school isn't far from where we live. So she commutes back and forth. So she's helping mom and dad save a little bit of money on some room and board. But every week there's a new envelope coming to our daughter from credit cards. Just, hey, you've been pre-approved, you've been pre-approved, you've been pre-approved. It looks pretty exciting. There's a right way and a wrong way to use a credit card, right? But what we're talking about here is just protect yourself so that you don't become subject to identity theft or a scam. It's very commonplace. I've been subject to it. My wife has been subject to it, and you just want to try to put these protocols and procedures in place to monitor your overall situation. So try not to let anybody else take advantage of you, right?
Well, no, I always find those credit card, when you get that credit card mail, and it says, you've been pre-approved for a credit card. Just fill out this form with all your financial information so we can approve. If I've been pre-approved, just send me the credit card.
That's right.
Right? Why do I need to give you all my information if I've already been pre-approved? Really, reality is they haven't pre-approved you for anything. They just send it to everybody. That's a good market. See, but that's the marketing trick. It's like, oh, look at this. I've already been pre-approved for a credit card. It's just a marketing trick. All right, they just, they want to get your information. They want to run you through the system. They want to give you a credit card. Look, the lending standards are pretty lax. But again, most people are going to get approved for a credit card because that's how the banks make their money. But again, this is all marketing. But again, we get sucked into this because it's hey, I could go buy this or buy this. I mean, it's just think about your phone, right? You trade in your phone all the time at Verizon or wherever you're getting your phones from. And it's like, oh, it's just an upgrade, right? You're ready for a free upgrade. It's not free. You're financing this over time. You're better off just to go buy the phone, right? Just save up the money and go buy the phone, and then just pay for your plan, whatever your plan is, and you get a fairly low plan. You'll actually wind up saving a lot of money over time, but we don't do that because it's free and easy, right? I just upgrade it. I keep paying on my bill every month. Go back and calculate how much you actually wind up paying for your phone over time, and you'll be amazed.
Yeah, the goal is all of these vendors or folks that we have to have the latest and greatest technology or tools, whatever it might be. They want us to get on a payment plan, because then that payment plan somehow just kind of gets lost in the budget, or we forget about it, right? Just like all these subscriptions for online streaming services and et cetera. It's just amazing when you go back and look at what you actually spend on this stuff, how it really just adds up over time.
Yeah. Just have a comment here in chat talking about, did Mrs. Roberts decorate the kitchen with some of her Christmas junk? I mean treasures. JP, I appreciate the comment. This is not my kitchen, although it's actually kind of close. But yes, my wife did decorate the kitchen, and I'm going to tell her that you said it was junk, and she's going to kick your ass. So, I know where you live, JP. So, yes, we have decorations. Our house has thrown up Christmas at this point. So we have Santa Clauses, we have nutcrackers. Besides my wife, we have nutcrackers. And we have Christmas trees and everything else going on. So, yeah.
Yeah, no pressure on that stuff either, right? So as we were getting into Thanksgiving and we're driving out of the neighborhood, my wife is like, oh, look, so-and-so's put up their Christmas. Oh, look, so-and-so's put up their Christmas. Oh, well, look, they just put up their Christmas too. I'm like, I'm not doing it. I'm going to give Thanksgiving the credit it deserves.
Exactly.
I will get the Christmas lights out, and I will do the exterior illumination after Thanksgiving.
There you go.
That's what we did.
And did you?
Peer pressure. Oh yeah. So now we're good. I got all the exterior illuminations all out there. The little lights, they're twinkling. You know what I'm talking about? So it's all good.
So yeah, no, it's funny too because you have these guys come by. They go house to house. Like, hey, can we put lights in your house?
Yeah.
And so they came by to give my wife a quote. I was like, no, I'm doing the lights.
Okay.
Because it was $1,000 a tree. I was like,
oh my goodness.
And so in our front yard, we have 7 oak trees. And so they're all fairly big oak trees, but we have these 7 oak trees that surround, we're on a corner lot. So these 7 oak trees surround the house. That's $7,000 for lights on trees. No, it ain't happening. So, yeah. So this is why I had kids. People think you have children for, I love kids. No, they're free labor. Right? You have kids. This is why I have 4 of them. I got free labor from 4 kids, and now they're bringing home boyfriends. Guess what's happening to the boyfriends? Yeah, they're in the pool. I now got 5. So, yeah, I've got a whole little army of people to do stuff now, save money.
Love that.
Yeah.
Absolutely. Put them to work.
Wait till grandkids come along. Oh, yeah. So,
Little Johnny.
I don't care if you're 1. Get out there and get to work.
That's right. Wrap the trees. It's all good.
Anyway, all right, we've digressed. Let's switch gears over to reverse budgeting. We've talked about before about needing, and particularly if you're younger, the younger you can start by building a budget and sticking to it, the better off you're going to be. What's really hard is once you're behind the curve, right? So we were talking about earlier that you take on a bunch of debt, you come out of college, you've got a lot of debt, you're taking on more debt to do whatever you want to do. And now you're really behind that curve. So now you can't save money, you can't invest money because everything you're making is just going to try to keep your head above water. And we hear a lot of stories about this. Like, it's so unfair right now. It's I can't make ends meet, and it's so tough. It is because we've gotten ourselves into this consumption-driven society where we have to have all these things that are actually wants. We classify them as needs, right? I need an iPhone. Do you really? I mean, just think about this. Do you really need an iPhone? Or could you use a cheaper type of phone, Android, whatever, and a cheaper service plan, right? Could you use Cricket, something like this, and still get done what you need to get done for work or whatever it is? Do you really need, 15 different subscriptions to different, streaming platforms, right? These are the questions that you really have to start to analyze. And when you start looking at your budget and where you're spending all this money, you're going to start realizing that that a lot of this money is actually getting wasted. It's like you're spending money on services that you're not actually even using. But you might use them someday, right? But you're not using them now. But this is how we get behind that curve. And so this is why we've talked about variations of this in the past, zero-based budgeting. There was a really good article out this week talking about reverse budgeting, and which is effectively a zero-based budget. They're kind of the same thing. And so you set up your budget. So I'm at 50% of my money that goes to the absolute necessities of life, right? This is your rent payment, it's your car payment, it's your utilities, it's your food, it's those type of things, right? The things you have to have in order to basically survive. Then the other 30% the next 30% of that is your entertainment, your clothing allowance, those type of things that you need, your hygiene supplies, etc. That's the next 30% of your budget. And then 20% of your budget goes to savings. Now, The problem for most individuals is that they start out the month, you get paid, and you start spending your money. And at the mid-month, you get paid again, and you keep spending your money, right? Because you have bills that come due at the beginning of the month, you've got bills that come due in the middle of the month, and so you just keep spending. And then at the end of the month, you go, well, there's no money left to save because I spent everything. And this is what we've talked about before, which is you need to reverse that process. As soon as you get paid, 20% of your paycheck goes into savings. Live on the balance. When you get paid again, 20% of that paycheck goes into savings, you live on the balance. And what's amazing is, and we've talked about this before, is that life will, if you do that, life will fit into what's left. If you try to do it the normal way, right, which isn't the best way, which is just spend and hope to save at the end, life will eat up everything in between. Something will happen, you'll have, some type of event occurs, whatever it is, and all of a sudden you got extra money going out the door. And so setting up yourself to save first and doing your budget in reverse, savings and then spending for everything else, you'll tend to live within that budget fairly well, and you can start actually building some net worth so that you can then afford at some point in the future to buy a house, buy a car, whatever you want to do.
Yeah, it's pay yourself first, right? So kind of that reverse budget, like Lance mentioned, I think so many of us, we focus on, well, here's the amount of money I have coming in, here's what I'm going to spend, and then here's what I can save. Save first, and then back into your budget. Save first, and then here's everything else that I can spend according to what I can afford, right? So pay yourself first. And I think as investors, what I see is there's such a focus on, well, what is the return of my portfolio? Look what the market's doing this year, but what is the return on my portfolio? Where I think there's a more important barometer or gauge that leads to your success over building wealth. Our portfolio returns important, yes, but I think what's even more important is what is your savings rate, right? What is your savings rate? I could even make an argument that you're better off saving 20% of your wealth, 20% of your income, let's say in a portfolio that might be producing even average returns over time, versus maybe only saving 5% of your wealth where you're trying to hit a home run and you're taking a lot of risk with that little bit amount that you're trying to save, every paycheck, whatever it might be. So, it's about, I think your savings rate is even more important over time than what your portfolio return is. Portfolio returns are important, obviously, but I really think it, like Lance is saying, pay yourself first. It's that savings rate that's really going to help you build the discipline to build your wealth over time.
Yeah. The return part really is not as important as everybody expects. The only reason we're so focused on returns is because of the greed.
Yeah.
It's our greed. It's our emotion of greed, right? It's like, oh, the market's up 10%. I want to make 10% or 12%, whatever it is. Or you hear what other people are doing. It's like, oh, I want to make all this money in the markets. But in reality, the way to build wealth is to save money. The return that you get on that money is not going to build your wealth. The more aggressive you get to try to build wealth through the markets, the larger the likelihood is that you'll actually wind up destroying wealth over time. If you focus on the savings part and then just invest moderately or modestly to grow those savings at the rate of inflation or a little bit better over time to make sure your purchasing power remains intact, you're going to do a lot better than the vast majority of other individuals. The more aggressive individuals are, the more money they tend to lose. And it happens repeatedly over time. They may do great for 5 years, 7 years, 10 years. They may do fantastic in the markets, and then something happens and they wind up losing a vast chunk of their wealth, through investing. And it happens all the time. But if you can just maintain, and this is why we spend so much time talking about risk management, risk controls, monitoring what you're doing, staying ahead of it, is because if you can minimize that downside, you can take some risk in the markets. I'm not saying you shouldn't, but you can take risk, but you can do controlled risk where you don't wind up destroying all your effort at some point down the road.
Yeah. I think for younger investors out there, I think you can, when you are saving and putting money aside and you're starting to build your wealth, I think just a very easy, low-cost way to start getting participation in the market, and I know I say this a lot, is just to use some index funds. like a Standard & Poor's 500 index fund. It's easy, it's low cost, and you're just going to track the market, right? And so, I mean, that's what we're doing with our daughters, 23 and 25. You know, we've just started them investing in broad-based index funds. And earlier this year, when markets were pulling down more egregiously, I got a phone call from our oldest daughter, and she's like, "Dad, what's going on with the market?" And I said, "Kiddo, you should be excited. Stocks are on sale. You know, just buy more, right?" But then, as we get a little bit older and we start accumulating wealth, and now our wealth is getting larger, as we're getting closer to that time where we need to start, relying and pulling from the portfolio. At that point, maybe you don't need to have 100% of your portfolio in an investment that is an all equity type of investment. Like Lance mentioned, you still want to have your money work and participate in the market so you can fight inflation, have enough growth to fight your taxes, keep your purchasing power, and live the lifestyle that you want to live. But at that point, it's not about taking the risk to try to match or beat the market. At the end of the day, what the Standard & Poor's 500 index is doing at that point really shouldn't be a major concern. It's more about what is that hurdle rate, or what is that rate of return that you need, regardless of what the market's doing. But what is the rate of return that you need for your financial situation to work? You're not going to get all the upside. You don't need to take all that risk. But at the same time, if markets start pulling down more egregiously, you don't want to get derailed, right? That's the balance of managing risk.
Yeah, that's very true. And this is also why, even when you're young, it's important to have it's always interesting. Let me back up. It's always interesting to me is that when you talk to really wealthy people, right, they have a whole group of people that they work with as far as advisors. They have a financial advisor, they've got a legal advisor, they've got an estate planner, they've got all these other people, they've got all these professionals that surround them to protect their wealth, to make sure it's growing, to make sure it remains intact, if you pay less in taxes, those type of things. But if that's what wealthy people are doing and you want to be wealthy, shouldn't you consider having those same type of inputs, right? And then, but we see a lot of this talk early on, kind of in the media and everything else is like, oh, you're young, just go buy index funds, just passive invest, these type of things. And that's okay, that works. But we neglect the most important things, which is the budgeting, the financial structures, those type of things. And so, getting a financial advisor early on in life that you can build a relationship with over time and use them as part of your professional group of people, right? You're going to need a lawyer at some point. You're going to need an accountant at some point. And those pieces you will bucket on as you kind of go along. But, getting a financial advisor early in life to work through the financial strategies, making sure you're staying on a budget where you can have a review, 6 months, every 6 months, every year. Where are we on the budget? Where are we on savings? How are we managing our credit? How are we managing our debt? Hey, I'm thinking about buying a house. Well, you're not really ready yet. Let's work towards this goal first and then get you ready to buy a house. Those are the type of things that a good financial advisor will do for you if you use them properly. The problem for most people is they have a bad rap about their financial advisor because they never use them properly, right? They just, I've got this financial advisor, I gave him money to manage. That's not what a financial advisor does, right? The financial advisor is doing the advising on your finances. They're not doing the investing or not doing it well, right? They can't do everything. So if you're just giving your money to a financial advisor and you're not happy with them because their returns aren't what the market is or whatever it is, you're using your financial advisor wrong. If that's the case, just go buy a mutual fund because that's what they do, right? Go buy an ETF because that's what they do. Your financial advisor there is to work through your budgeting, your planning, your structure of your finances, how much you're saving, where are you saving that money? Do you need insurance? Do you not need insurance? Do you need health care plans? All those type of things that will make sure that you grow your financial wealth over time. But again, the vast majority of people that I meet with do not use their financial advisor properly.
Yeah, there's portfolio management it's one leg of the table, but there's all these other moving financial pieces of somebody's life that Lance was just talking about, right? And especially when I am visiting with younger investors, sons and daughters of clients that we work with. One, that's the best compliment that I can ever receive as an advisor when a client says, hey John, would you mind visiting with our son or daughter? They're coming up, they're about to graduate from school. I just want to make sure I'm on the right track. Absolutely. Again, in this profession, It is the best compliment that I think an advisor can ever receive. But in those conversations, I always tell the younger generations, like, look, there are a lot of folks that I work with who are much older than you. They are about to retire or they're getting near retirement. There are some things that we can focus on right now when you are young that will help set you up for even more success when you're a little bit older, right? So what are some things that you can do now as a younger investor that 10, 20, 30, 40 years from now, you will have better control over how you can control your income, how you can control your taxes, looking at different buckets of money, taxable money, tax deferred money, tax free. Let's look at what are your insurance needs, all of these things. So many young investors that I visit with, they've started to save, but they've put money into, let's say, traditional IRAs. Okay, that's fine. Well, let's maybe it makes sense to convert. Let's take that money out of that traditional IRA and pay the tax right now while your income's low. Let's get that money in a Roth IRA so now it can grow tax-free 10, 20, 30, 40 some odd years. And it's even at a young age, I tell folks, look, your Social Security decision, your Medicare decision, that's not even on your radar screen right now. But someday it will be. But let's do some things now to put you even in a better position in the future, right? So all these things that Lance is talking about, that's really where I spend a lot of my time during the day. Yes, I'm always helping clients review portfolios. We're always talking about the markets. We're looking at returns. We're looking at hurdle rates. But then I want to help them. I want to help folks look at everything else to make sure we're looking at this in a total, complete financial picture. And when you're out there, when you're looking for an advisor, you want to make sure you are working with a fiduciary who puts your needs ahead of their own. You want to make sure you're working with a fiduciary. And I had in a recent conversation that I had with a prospective client. This is a couple that was not clients of our firm yet. They asked me this question, and this is a question that I have not received in quite a long time. They said, John, is there ever a point in time where you take your fiduciary hat off when you're working with clients? My answer was no. So you want to make sure that you're always working with a fiduciary where they're looking out for your best interest and looking at all those areas that Lance was talking about to make sure they're looking at your complete financial picture.
Yep, exactly.
Yeah.
So before we wrap up the show today, put in chat one if y'all want to do live Q&A tomorrow. We did this last week. It was a lot of fun. If y'all would like to do live Q&A again tomorrow on the show, put one in the chat and we'll do that. If not, I'm going to bore you with something from Danny Ratliff. So anyway, but yeah, a lot of these things are just these are kind of common sense things, but again, in a lot of cases, these are things that we just overlook. Whether it's managing your credit card, making sure that your credit score is in good condition, making sure that you're not getting taken advantage of somebody, and this is also important if you have elder parents that you're looking after. Work with them to pull their credit reports. Make sure and look at their credit reports because it's easy. There's a lot of elder care scams. There's a lot of elder scams that go on in general. As they get older, they become more of a target, particularly if they have some assets. So again, make sure that if of those that you are caring for, be sure and pull those credit reports and keep a watch on it. There's a lot of good systems out there as well that you can sign up for, like Equifax and others. You can actually sign up with Equifax and monitor your credit directly through their website. So you can do a lot of those things as well. There's a lot of apps out there that'll help you do it, but it's just something worth doing because again, if you finding out after the fact, it's really a mess to try to clean all that up.
Yeah, if you're talk with your parents, especially if they're getting older, engage with them, ask them who they work with, what financial folks do they work with. If you start noticing some changes, and just pay attention to what they're doing because I find that the elderly, they're just being targeted more and more, and folks out there are getting very creative when it comes to scams and stealing identity. My own father was subject to this earlier this year, and growing up as a kid, my wife thinks that I'm pretty tight from a budget standpoint. I'm a planner, I can't help it. But man, being raised as a kid, my parents, I mean, they watched every single thing that they spent. And even earlier this year, I noticed some changes in some behavior with my own dad. And I mean, he's fine, everything's well there, but he made some decisions that was typically decisions that he would not typically make, right? So it was a red flag. And so I have 2 younger sisters, and so the 3 of us got together, and we're starting to just pay a little bit of extra attention to what mom and dad are doing. So I just want to relay that out there to folks. Just visit with your family, visit with your loved ones, especially if your parents are getting a little bit older. Just spend a little extra time to pay attention to what they're doing, so hopefully they don't fall victim to a scam, because like Lance said, it's once it happens, it's hard to unwind from that.
Exactly. So we're getting quite a few ones in chat. So yeah, we'll do live Q&A tomorrow. So bring your best questions tomorrow. Danny Ratliff will be here as well to help me out with that. Please like and subscribe to the channel. It certainly helps us a lot, particularly as we get ready to wrap up the end of the year. We're starting to do a lot of our planning for next year, next events, the live events that we're going to do next year, a lot of the candid coffees. We've got a lot of things planned for you guys next year as well. So input from you is always very important here on the channel. So again, like and subscribe. Drop your comments in the chat. We always look at those. And of course, be good. This is the important thing. So,
Absolutely.
all right, we will wrap it up today. Be sure and go by the website, realinvestmentadvice.com, and get your ticket for the upcoming Economic Summit. We're going to be covering artificial intelligence. We have a gentleman from BlackRock to cover that. We have a very young gentleman from DeFi Development to talk all about cryptocurrency, stable coins, kind of the future of Bitcoin and that environment. Ed Slott, who's America's financial planner, talk about financial planning advice. Of course, myself, Mike Leibowitz, Adam Taggart will be there as well, talking about markets, money, fixed income. We're going to be covering a lot of stuff. It's Saturday, January the 17th. Tickets are on sale now. So if you want to get your ticket, they are selling pretty quickly. So if you want to get your ticket, you need to do so now, and we'd love to see you there. All right, that wraps up the show for the day. We'll see you back here tomorrow. We'll do live Q&A with Danny Ratliff. See you then.